Right, before we get into this example, let's just quickly look again at a few parties that is involved in a company. So firstly, we have our directors. So let's draw our directors here. Here they are. There we go. There's our CEO, and just a little bit smaller, there's our CFO, and they are responsible for running the company, and we can say that they effectively control the company. So let's just draw our company here. Here is my company. There we go. There is the company. Good. Then there's another group of people which we call the shareholders. So here are my shareholders, and they are part of the public in a public company. Right. So they are the providers of financing. All right. So they give financing to this entity for the shares that they get in return. So in return for this financing provided, they are going to get a little share certificate saying that they own a share. So there we go. They get shares in return. These guys we call the shareholders, and they effectively own the entity. So there we go. So the directors are the ones who control and run the entity. The shareholders are the ones who own the entity. Now, you can clearly see that these shareholders are not directly involved in running the affairs of the company. So the directors will be drawing up some financial statements, and they may be biased when they draw up these financial statements, just so that their work appears to be good and that they can be remunerated well. So to make sure that these shareholders' money is being protected, we need to introduce another party, which is this guy here in red, and we're going to call him, this is our checker. So he's going to make sure that the financial statements prepared by the directors are actually fair and reliable. And he's known as the independent auditor. Great. So there he is. We should probably draw him a little gray suit, but nevertheless, there's our independent auditor. He's going to make sure that these financial statements are reliable. Now, to help him inside the company, there's another little man. Oops, he's got a little bit of a big head. And we could call this man the internal auditor. Now, he's also employed by the company, and he's responsible for designing and implementing controls. So he will design procedures, for example, to make sure that the person authorizing the payments is not the person who actually makes the payments as well. So just separation of duties, etc., to make sure that there is good control practices within the entity. He will also assist in the preparation of these financial statements. So there you go. There's the four main parties that is involved. You've got your directors who run the company, the owners, which is known as the shareholders who own the company. They also provide financing to protect these public owners' interest. The shareholders are going to appoint an independent auditor who is going to check these financial statements. Great. Now, we can get back to our question, and let's do that. Our question says, on the 30th of June, Wise Guys Limited paid the independent auditor, KBNG auditors, 45,000 Rand for the work done to date. At year end, 31 December 2013, 63,000 was still owed to them. So 45,000 was paid to the auditor, and 63,000 Rand is still owed to them. And also on 31 December, Wise Guys paid Mr. K. Mlambo his monthly contracted salary for the internal audit work performed. Good. Our question says, show the effect of the above transaction on the journals, the general ledger, and the balance sheet to the extent that they relate to the audit fees account. Okay, so that's quite an important piece of information there. The reason for that is we're only looking for the amount that is going to affect the audit fees. So if we look at this last sentence, the money paid to Mr. K. Mlambo is for internal audit work done. So that has got nothing to do with audit fees, which is the amount that is paid to the external auditor. If we go back to our picture here, the audit fees is what is being paid to the external auditor. So at this stage, we are not concerned about the monies that is being paid here to our internal auditor. Good, so we're only going to record the audit fees. Right, so this is not a very complicated example. Let's quickly determine our debits and credits. The first transaction here is the 45,000 Rand that was paid to the auditor. So if we paid money, we can already know that my bank account is going to decrease. So let's quickly look at the two accounts affected. Number one, we've got our audit fees that was paid. So we've got audit fees here. There we go. And number two, we've got our bank account, like we said, which is going to be decreased. So bank we know is an asset. We know our asset decreased. We know if an let's just do the audit fees as well. We know audit fees is an expense. The reason for that is if we would like to use the independent auditor again, well, we're going to have to pay for his services again. The audit fee is increased. All right, so let's look at my debt click rule, which says debit, expenses, assets, and drawings if they increased. And we're going to credit liabilities, incomes, and capital if they increased. So here we've got an expense that increased, so that's going to be a debit. And we've got an asset that decreased. So we've got an asset that didn't go up, it went down. So it's going to be the opposite of this debit, and it's going to be a credit. Good. So that is the first transaction. So let's quickly record that. We're going to record this in our journals. In the subsidiary journal, it's going to be the cash payments journal because we gave out cash. So let's quickly look at that. There we go. It was paid on the 30th of June. Wise Guys Limited. My details here is going to be KBNG auditors, because that's the third party that was paid. And I'm going to record that in the bank column, 45,000 Rand, which was paid in cash. There's going to be no column for audit fees, so we're going to record this all in the sundry accounts column, 45,000 Rand. My details is going to be audit fees. And this is an expense, and we know this is an asset. Great. So then we can post this to our ledger. If we go to our ledger account, right, the two accounts affected in my ledger is going to be my bank account, and secondly my director's fees, not my director's fees, my audit fees. Right, that is account N8. We're going to assume that's the code for audit fees. This one is an asset, and this one is going to be an expense. Asset and expense, they both increase on the debit side and they both decrease on the credit side. So what happened to my asset here? It went down because we gave out 45,000 Rand. What happened to my expense? It increased by 45,000 Rand. And we can complete the rest of our details here. There we go. The opposite account here is bank, and the opposite account here is going to be audit fees. Good. We get this from the CPJ. Refer to our bank account, and we can refer to our audit fees. So let's post from the journal. Amount here is going to be N8, which refers to the account code for audit fees, and then the account code for bank is B1. So we can put B1 under the bank column. Good, that's the general ledger. Lastly, just quickly the effect on the balance sheet. Here we go. Our cash is decreasing by 45,000 Rand, and my expense, which decreases profit, is increasing. So if my expense increases, my profit decreases. If my profit decreases, my retained income also decreases. So I'm going to decrease my retained income. And there we go. Let's quickly do the second part of this transaction, which was the 63,000 Rand that is still owed to the auditors at the year end. Now, instead of having this bank as a second leg, we're now going to have expense payable because we still owe money at the year end. So let's take out this bank here. There we go. We're going to take out bank, and the account affected is going to be expense payable. Right, what type of account is expense payable? The debit side is going to remain exactly the same. Sorry, I never put the right amount there. My second account is expense payable. There we go. What type of account is expense payable? It is a liability because we still owe money to the independent auditor. So let's record that as a liability. All right, what happened to my liability? Well, do we owe more or less money after this transaction? We owe more money. We haven't paid the independent auditors all the fees for the work that they performed, so that is going to increase my liability. So now I've got a liability that increased. If I go to debt click, a liability that increased is going to be a credit. The debit stays exactly the same. I've used the services of the auditor even though I haven't yet paid for them. My expense still increases. This is due to the accrual principle. Even though we haven't paid the expense, we need to record that in our books because we have incurred the expense. What that means is we have used the services. We have actually used the audit fees. We've actually used the services of the auditor, even though we haven't paid for it. Thus, we need to record an expense. That is known as the accrual principle. Okay, so let's do this in our journals. The journal that we're going to record this in. There was no payment that took place, so we're not going to record it in the cash payments or the cash receipts. We're going to go straight to our general journal. Again, we don't have a document number, so we're just going to say JV. This was on the 31st of December, and our debit is going to be audit fees because that is what we paid, and our credit is going to be my, go back here, expense payable account that we have not yet paid, sometimes also referred to as expenses accrued. So there we go, let's put that in. Audit fees is an expense, expenses payable is a liability, and the amount that we owe at the end of the year is the 63,000. There we go. Debit audit fees, credit expense payable. Audit fees we said is account number N8, expenses payable. We said, well, we haven't said anything yet. So let's have a look here. Expenses payable, we're going to call that account number B2. It's a liability. We're crediting expense payable with 63,000 Rand because we owe more money. You can see expense payable increased 63,000 Rand. And there we go. Oops, 63,000. And we debit our audit fees with 63,000. We got this from the general journal. And we've already done our posting here in N8 and B2. Good. And then we can just fill in the dates here. Just need to correct this one. This should have been 30 June 2013. All right, 31st of December. And the contra account here is not bank because we haven't paid it in cash. We owe this money, so we're going to have the contra account expenses payable, and under expenses payable the contra account is audit fees, and that is an expense. Right, 31st of December is my date, and that is my ledger complete. So you can see the first transaction we paid in cash, my bank decreased. The second transaction we still owe that, so my liability increased. Both of them we've used the services of the auditor, so my expense increases on the debit side. The one we've paid, the other one we still owed, but due to the accrual principle, we need to record the expense for both of them. Lastly, our effect on the balance sheet. The second transaction, we didn't give out any more cash. However, we do owe more money, so my liability increased by 63,000. Secondly, my expense increased by another 63,000. So now we don't just have, show you my formula bar. Now we don't just have this 45,000. Look at the top here. We now have minus 45,000 minus another 63,000, which gives me minus 108. And you can see my total equity and liabilities equals my assets, which is the accounting equation. Brilliant. Happiness. Great.